A commercial real estate loan is a mortgage secured by businesses for income-generating properties such as offices, stores, apartments, hotels, and warehouses. For this type of loan, let's go over some terms we need to be familiar with. First is the capitalization rate. This is simply referred to as cap rate. It is equal to the percentage of the net operating income over the current market value or the purchase price. The cap rate tells a lender how long it would be until the investment is recovered. For example, a 10% cap rate will take 10 years to recover. The higher the income of the property, the better the cap rate will be. This is another great back-of-the-napkin formula. A lender will not make a decision on funding based solely on a cap rate. Instead, they will utilize this formula to quickly understand if the property may have income challenges now or in the future. This also means that you can use this formula as a broker to analyze the deal in the exact same way. One unique thing you can do as a broker is structure deals with multiple lenders. This is known as capital stack financing. It may be a very fringe service you can offer as you begin your career as a broker, but capital stack financing is where the very large deals take place. There is no limit to the amount of capital you can stack because there is an unlimited number of parties that can be involved. We will not see capital stack financing in small deals. However, you can quickly see how a large resort or real estate development project costs billions. It would be rare to have one funding party providing all of the capital necessary to conduct this effort. In commercial real estate, these stacks typically include common equity, preferred equity, mezzanine debt, and senior debt. Each of these investment levels comes with its own unique risk and rewards. Typically, higher positions in the capital stack earn higher expected returns due to their higher risk. Let's describe some of these terms in more detail. Mezzanine financing. This is a hybrid of debt and equity financing that gives the lender the right to convert to an equity interest in the company in case of default, generally after venture capital companies and other senior lenders are paid. In preferred equity, all cash flow or profits are paid back to the preferred investors until they receive the agreed-upon preferred return. Common equity is very straightforward. Instead of receiving payment for a debt, common equity parties receive an agreed-upon percentage of the profits in perpetuity. Unlike preferred equity, where they only receive a portion of the profits until they are paid the agreed amount. My guess is that this information is intimidating. Well, do not get too flustered regarding capital stack financing. Remember, you are a referral partner to your sources of capital or your lenders. You will likely have a relationship with a developer or a potential client who will come to you and ask you if you have any of these sources. You will simply make the introduction, and at that point, most of the deals in capital stack financing are solely based on contractual agreements. This means that after you make the introduction, attorneys on both sides will likely handle negotiations and documentation. Your lenders will guide you through the process and ensure all communication is transparent. Trust us, the size of these deals are worth the effort they will take to get across the finish line. So far, we have only covered some fringe things you can do in commercial real estate. So, where are all of the normal deals? Don't worry, you can do all of the typical deals. Beyond what we have discussed already, you can source capital for the following property types: hospitality, industrial, land, mixed use, multifamily, office, retail, self-storage, senior housing, and student housing. For each of the property types that we just mentioned, you can offer all the following loan types: acquisition, bridge, cash out, construction, mezzanine, preferred equity, refinance, recourse, and non-recourse. There will also be various other commercial real estate products in your software platform that will be added or updated over time. Commercial real estate deals should not be confused with consumer residential mortgages. In the mortgage space, there are very clear lending criteria, and if those criteria are met, the lender will land. Every single commercial real estate deal is unique, not only to the lender, but also to the property in question and its location. Your client may even be required to have certain people on staff like a general contractor. Do not let this intimidate you, but also manage your own expectations as well as your clients'. In residential mortgages, you can get pre-approval in minutes and close on a mortgage in as little as 14 days. This process does not really exist on the commercial real estate side. You can expect most commercial real estate deals to take at least 30 days for funding. But for some of the more complex scenarios we have discussed in this section, it could take months. Remember, the deal size is much larger than a standard mortgage, and therefore the commissions are much more lucrative as well. The average commission for CRE is 1 to 4 points. A fee split, or it is externally negotiated,